This is Xu Jiajin, the CEO of Evergrande. He was responsible for turning Evergrande into one of the world's largest property developers. But now, his empire is crumbling. Xu was arrested in 2023 and Evergrande has been liquidated, symbolizing the broader challenges facing the Chinese economy. The Chinese economy is slowing down, and that raises several pressing questions. Why is this economic giant struggling? How did the once booming real estate sector, exemplified by Evergrande, lead to such a crisis? And what are the broader implications for the global economy? In this video, we'll dive deep into the factors causing China's economic slowdown, explore the impacts on global economies, and uncover what this means for you. Before we get into the problems with the Chinese economy, we need to talk about how China got here in the first place. China's economic transformation began in the late 20th century, turning it into the world's manufacturing hub, or the world's factory. This remarkable shift started with Deng Xiaoping's economic reforms in 1978, which moved China from a centrally planned economy to a more market-oriented one. Deng's policies included introducing the household responsibility system in agriculture, creating special economic zones, and opening up the country to foreign investment and global markets. These reforms led to rapid industrialization and urbanization, effectively compressing the Industrial Revolution, which took centuries in the West, into just 1 or 2 generations in China. China's meteoric rise brought impressive growth, massive infrastructure projects, and a significant rise in living standards for many Chinese citizens. Examples of these projects include the Three Gorges Dams, the world's largest power station in terms of installed capacity, and the extensive high-speed rail network, which is now the largest in the world. However, behind this growth laid unsustainable practices and looming crises. The rapid development led to environmental degradation, including severe air and water pollution, and growing income disparity between urban and rural areas. China's economic model heavily relied on exports and investment, leading to overcapacity in several industries. For example, the steel and cement industries have produced more than the domestic market can consume, resulting in ghost cities with empty skyscrapers and unused apartment complexes. Local governments, incentivized to pursue growth at any cost, have accumulated massive debts, often funding unnecessary infrastructure projects. Examples include the new South China Mall, the world's largest shopping mall that has remained largely vacant since its opening, and the Kangbashi district in Ordos, designed to house 1 million people, that remains largely uninhabited. All of these issues have helped set the stage for the economic challenges that China faces today. But by the early 2000s, China had become the second largest economy in the world. But this rapid ascent came with a price, and the economic model that had fueled China's growth began to show signs of strain. Evergrande was once a symbol of China's rapid urbanization and economic boom, but it has now become a cautionary tale of over-leveraging and speculative growth. This real estate giant, with over $320 billion in debt, exemplifies the unsustainable practices that have contributed to China's current economic woes. Evergrande was founded in 1996 by Xu Jiajin, aka Hui Ka-yang. Evergrande grew rapidly by borrowing heavily to finance its projects, selling properties before they were even built, and expanding into unrelated sectors such as electric vehicles and bottled water. At one point, Xu Jiajin was one of Asia's richest individuals, and his ambitious vision and aggressive expansion strategies propelled Evergrande to become one of China's largest real estate developers. However, these same strategies led to the company's downfall when it could no longer sustain its debt load. In 2020, the Chinese government introduced the 3 Red Lines policy, aimed at reducing the real estate sector's reliance on debt. And Evergrande, failing to meet these requirements, faced a severe liquidity crisis. Recently, a Hong Kong court ordered the liquidation of Evergrande, marking the official collapse of a company that once symbolized China's economic miracle. The broader implications of Evergrande's collapse are quite profound. Real estate accounts for about 30% of China's GDP, and with strict capital controls, it's been one of the few ways for ordinary Chinese citizens to get rich. And what I mean when I say capital control is that a Chinese citizen can't easily invest money in, for example, the US market. So the collapse of Evergrande threatens millions of investors and home buyers, many of whom are left with unfinished properties and quite uncertain futures.
Boss of indebted property developer China Evergrande has reportedly been placed under police surveillance.
Evergrande's struggles has also been compounded by criminal investigations into Xu Jiajin. He came under scrutiny for unspecified criminal behavior, whatever that means, further destabilizing the company's effort to restructure their debts. But the downfall of Evergrande is just one piece of a larger puzzle. Another critical factor in China's economic challenges is its population dynamics. The one-child policy, once seen as a solution to overpopulation, has created significant demographic issues, including a shrinking workforce and an aging population. China's one-child policy was implemented in 1979, and it was intended to control the rapidly growing population. And it successfully reduced birth rates, but it also led to unintended consequences. The Chinese workforce is contracting as the population ages, which is leading to fewer young people entering the labor market. This shift places a heavy burden on the working age population to support the elderly. And according to commentators like Peter Zion, China's demographic structure is problematic because it lacks the younger generations needed to sustain economic growth and support the aging population. Zion often points out that this demographic imbalance could lead to a decline in productivity and economic stagnation. And this isn't something that might happen, this is already happening. In 2022, China's birth rate fell to 6.7 births per 1,000 people, the lowest since record keeping began in 1949. The country recorded its first population decline in 60 years, with the population decreasing by 850,000 people in 2022. An aging population also means higher healthcare and pension costs, straining public finances and public services. By 2050, it's projected that 1 in 3 Chinese citizens will be over the age of 60. As we look at the population pyramid, sometimes referred to as a Christmas tree graph due to its shape, we can see a broad base of elderly individuals compared to a much narrower younger generation. This inverted pyramid highlights the severe imbalance. Currently, there are about 166 million people aged 65 and older in China, and this number is expected to rise to 365 million by 2050. The median age in China has increased from 24.9 years in 1990 to 38.4 years in 2020 and is projected to rise further. Furthermore, there is a cultural preference for male children in China, which has led to a significant gender imbalance. And as of 2020, there were approximately 34 million more men than women in China. This imbalance further complicates social stability and economic planning, as there are fewer women to marry and bear children, perpetuating the cycle of lower birth rates. Not all commentators agree on the severity of the impact, and some argue that increased productivity through automation and AI could offset the demographic decline. But as it turns out, implementing technologies such as AI and automation isn't easy for China. Ongoing trade tensions and technology bans have hit the Chinese economy hard. The US-China trade war, initiated in 2018 by the Donald,
China, I love them. China, 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 China. I have to have my China.
Marked the beginning of significant economic confrontations between the two largest economies in the world. Tariffs were imposed on hundreds of billions of dollars worth of goods, affecting industries ranging from agriculture to electronics. This trade war led to increased costs for businesses and consumers, as well as disrupting global supply chains.
Run Depot, the price go over $100.
The tech sector in particular has been heavily impacted, and the US has imposed strict bans on the sale of semiconductors and other critical technologies to Chinese companies, citing national security concerns. One of the most notable cases is the blacklisting of Huawei, a leading Chinese telecom giant. This ban prevents Huawei from accessing essential American technology, including semiconductors from companies like Intel and Qualcomm, which are crucial for its products. These restrictions have forced Chinese tech companies to seek alternatives, often at a higher cost and with lower efficiency. The semiconductor industry, which is a vital component of modern technology, has been significantly disrupted. China has ramped up its efforts to develop a self-sufficient semiconductor industry, but this is extremely challenging and a time-consuming process. As if to cause even more trouble for China, the US has targeted the largest chipmaker in China, SMIC, by restricting its ability to acquire advanced manufacturing equipment. And these measures are a part of a broader strategy to curtail China's technological advancements and its potential military applications. It's not just Chinese companies being affected by this. Nvidia has also been affected by restrictions and have been redesigning GPUs in order to comply with US export controls. These altered GPUs have reduced capabilities compared to their US counterparts, making them less attractive for cutting-edge applications in AI and data processing. However, there have been reports of companies using Singapore as a way to purchase unaltered GPUs and circumvent these restrictions, which highlights the ongoing complexities and loopholes in the enforcement of technology bans. The disruption in the supply chain has led to increased production costs and delays in product development, and companies on both sides are feeling the pressure, with Chinese firms struggling to access critical technologies and American companies losing a lucrative market. China's economic slowdown will have ripple effects all across the globe. As the world's second largest economy, China's interconnectedness with global supply chains means that its economic health directly impacts many countries and industries. And the slowdown in China has led to disruptions in global supply chains affecting manufacturing and trade worldwide. The slowdown has particularly significant implications for China's major trading partners, including Taiwan, the US, and the EU. Taiwan, which is heavily integrated into the global tech supply chain, relies on China for a substantial portion of its exports, particularly in the semiconductor industry. Any disruption in China's economy can lead to significant production and supply delays for Taiwanese firms. For example, in 2022, Taiwan's exports to China and Hong Kong accounted for 42% of its total exports, highlighting the deep economic ties between the countries. For the US and the EU, China is a major market for goods and services. In 2021, the EU exported goods worth approximately 223 billion euros to China, while the US exported around $151 billion worth of goods. A slowdown in Chinese consumer demand affects exporters of luxury goods, automotive products, and industrial machinery. Additionally, many multinational companies with manufacturing bases in China are experiencing increased costs and supply chain uncertainties, and this has led to a re-evaluation of global supply chain strategies, with some companies considering relocating their manufacturing bases to other countries to mitigate risk. Another question worth asking is, could China's slowdown be a silver lining for global warming? The reduction in industrial output due to economic slowdown has the potential to decrease emissions, and China's massive industrial sector has been a significant contributor to global greenhouse gas emissions. A reduction in manufacturing and construction activities means fewer emissions from factories, power plants, and vehicles. This potential silver lining does come with its own complexities. While reduced emissions are beneficial for the environment, the economic hardships resulting from the slowdown can affect investments in green technologies and renewable energy projects. But what does this mean for you? As companies move their manufacturing out of China to other countries, the initial disruptions in supply chains can lead to temporary shortages and higher prices for various products. Electronics, clothing, and household goods might see price increases as companies adjust to new production bases and supply chain routes. For example, the cost of consumer electronics could rise due to the complexities and expenses involved in relocating semiconductor manufacturing. On a positive note, diversification of supply chains can lead to improvements in product quality and innovation. And as companies spread their manufacturing to different countries, they'll often invest in new technologies and processes, leading to better products. Additionally, competition among new manufacturing hubs can drive innovation and efficiency. For individuals in emerging markets like India, Vietnam, and Indonesia, the relocation of manufacturing presents new job opportunities and economic growth. Increased foreign investment can lead to development of new industries, infrastructure, and higher living standards. If you live in one of these regions, you might see more job openings and improved local economies. Just how much the Chinese economic slowdown will affect the rest of the world remains to be seen, but I think it's safe to say that if the world's second largest economy starts facing problems, the rest of us probably will too. If you want to learn more about China and Chinese companies, watch this video about Temu, where I'll tell you why you should avoid them at all costs.